A lot of changes happen during the second half of life. Join Kash Mahmood, owner of Vargo Hospice and Home Health, and his guest as they explore topics to help you navigate the second half of your life. And now, here's Kash.
Hello, everyone. Thank you for joining me, Kash Mahmood, with Second Half of Life. Today, we will be talking to Arturo Barillas with Wealthwave, and our topic of discussion is planning for the uncertainties of life. Arturo, how are you doing today?
Cash, doing great, thank God. Happy to see you, happy to be here.
Excellent. Well, I was thinking we dive right in. Why don't you do a quick introduction to our viewers about who you are, what you do, how you got into this industry, and then we'll go a little bit deeper into long-term care and some other key topics.
Awesome. So my name is Arturo Barillas. I'm partnered with Wealthwave. We're the How Money Works company. And the main thing we do is we teach people how money works because we want to make sure people can truly live the American dream and not the American nightmare a lot of us are going through right now, right? Where we're month to month, check to check, and doing what we call the sucker cycle, right? Where you make money, it's gone. You make money, it's gone, and it repeats every 2 weeks. And one of the things I saw is that this is not taught in school. So I'm a former school teacher, and I realized when I'm trying to help my students that 9 out of 10 of the problems they had was because their parents were never home trying to make money, right? Either they had 3 jobs or one long job that had long hours, but the parents weren't there, and that damaged the kids. And that vicious cycle repeated itself because then the parents felt guilty because they weren't with their kids because they were working, and they would overspend on gifts for their children to feel better that they weren't there. And all of a sudden we have kids that don't have parents at home, and it's horrible. And I, as a teacher, I want to have impact. But I want to have impact that I can measure, see, and follow through. And as a teacher, you have impact. I mean, they get their 1, 2, 3s and ABCs. But after that, unless these kids strike it down in the future, which some have, but you don't really know how much impact you have and how long it lasts. Whereas with financial education, you instantly can see and plan out and map out the impact it's going to have. And it can be generational, and you can change a family tree for a long time.
Mm-hmm. Mm-hmm. Yep. No, I agree. Financial planning is one of those things that it's never too early to start. And the way you plan it and the way you execute it is actually going to help, for the lack of a better word, in the second half of life, right? It's what you do and how you do things. So
and that's the one thing, right? So we always know there's things that are going to happen, right? So there's uncertainties that are certain, right? One of those, obviously, the worst case scenario is death. We're not going to get out of this one alive, right? And we can plan for those things. But other things, and it's something we're going to talk about today, is that second half of life, as you get older, you could have been as healthy as an ox, but eventually something's going to break, something's going to fail because age is what happens. It's just life. So we can plan for those things ahead of time. For pennies on the dollar today, so in the future it doesn't break the bank for you, because we really want to protect your income and your savings, right? That's one of the biggest things. So those are 2 certainties, for the other uncertainties that we can plan for. The other one is obviously previous to that, temporary disabilities, right? You broke a leg, you got COVID, you can't go and produce income for your family because you're sick and it's temporary. We can protect you for that. So stuff like that. And that affects people harder in the second half of life because they don't have the time to compound and come back from that loss or that impact, right? So the closer you get to retirement age, the harder it's going to hit you and the less time you have to recuperate any loss you have.
Gotcha. So would you say that everyone needs long-term care, or how do you make that assessment?
So realistically, 70% of people will need long-term care, right? That's a big number. 70% of people will need long-term care. That means if you don't need it, you're going to pass away before that happens. So realistically, everybody should plan ahead for long-term care. It is devastating families financially and emotionally when they can't support that loved one that needs that long-term care, or worse, hospice care. If they don't have a plan in place, it's not only affect the emotional side of things, it's going to drain their finances very quickly. And once that loved one is gone, it's going to leave not only the emptiness of not having your family and loved one there, but that financial distress and problems.
So there is this confusion out in the marketplace about long-term care. as being a use it or lose it kind of a product. Are these annuity based, or do you have to use them while you have them, and then if you don't use them, you just can't reap that benefit? How does that work?
So the blanket answer is it depends. There are some policies that are use it or lose it. Normally, when they're standalone policies, they are use it or lose it. So they have a useful period, and if you pass away and you didn't have an additional benefit called a rider as a death benefit, then what you put in there is lost. Okay, and that normally happens with some companies with standalone long-term care products. Okay, but if you partner that long-term care with life insurance products as an additional rider, then first it comes at pennies of the dollar, and it's not use it or lose it because it's tied to your death benefit. So if you don't use it, your family still gets a tax-free death benefit for it.
Oh, interesting. Okay. What about the premiums? As one ages, do they stay the same? Do they go up? How frequently do they get evaluated?
So if it's a standalone long-term care policy, many companies have the right to increase the cost of the premiums as time passes by. And many have done through the years when it's a standalone policy. That's why many times when we go to companies, you want to refer customers to companies that are mutually owned, because they normally will make decisions in the best interest of the customer. And one of those decisions is keeping the premium steady. However, if you want a guaranteed low rate that stays the same, that rider attached to a life insurance policy, 9 out of 10 will not go up in premium. So the premium is set for the duration of the life.
Oh, okay. So based on what you're describing, I'm assuming that long-term care is not just a standalone plan. You can mix it with other plans and then just reap the best benefits. So how do you want to identify what's the right way to go?
So it depends on the person's specific situation, right? Because if you're going through the life insurance route of long-term care, you have to qualify for the life insurance part. Even if it's a standalone plan or it is a rider, there is medical underwriting. So if you fall under one of the risk categories, you may not be approved for a long-term care rider or a standalone policy. However, you mentioned annuities. So in many cases, if you have enough money to put into an annuity, there's annuities that have a long-term care rider without medical underwriting. There is age limits, but if you're below that age limit, and depending on the company, some go up to 75, some stop at 70, some stop at 65. But depending on your situation, your needs, and your goals, and where you're at, there are different plans that can be tailored for you. In addition to that, the closer you are to retirement age, the harder it is to get a standalone long-term care plan because you're higher in risk because of your age. So that's where an annuity-based product with a long-term care rider attached to it can be used. Now, yes, the problem with those is they're only attached to the monetary amount you put up front, not to a monthly premium. So the problem with that is you can only get so much long-term care benefit from it, but it's better than not having any.
Right. Okay. So I also look at long-term care as potentially a bridge where you have, we'll just go into like home health or hospice benefits, right? I mean, you have a certain amount of benefits that are covered by Medicare, a certain amount of benefits that are covered by Medicaid. If you have long-term care insurance on top of that, would that supplement or complement the existing benefits so you can get more when you really, really need the service?
So in general terms, yes. So once you qualify for long-term care, there's normally a 90-day elimination period. So you have to wait 90 days to qualify for it. And once you've qualified, it is implied that long-term care leads to hospice care. Okay? Because statistically speaking, anybody that goes into long-term care will not live past 4 years.
Gotcha. Okay.
So normally that means there's a progression into hospice care if need be. And depending on the policy, it has different, amounts, minimums, maximums, things you can use. But yes, it can transfer into the long-term care into hospice care according to the plan you have.
Gotcha. Okay. Yeah. And so how does the reimbursement work on these long-term care policies? Do you pay out of pocket, keep the receipts, and then get reimbursed?
I'm going to say yes and no. It depends, right? So it depends on the policy you have. So Many standalone policies after the 90-day period, the elimination period, require you to keep receipts of your expenses, and they will refund you. Okay. That's not a bad deal, but the problem is if you don't have somebody that you can trust to keep track of your bills, or you're not competent because of the need of long-term care, then it adds a layer of complications. So most of the time, if customers can qualify, I want to make sure they can go to a cash indemnity long-term care program where they get cash, no questions asked. But once they qualify, that money comes into their account, and they can use that as they see fit. So, for example, if you start long-term care, you're still coherent, you still can help yourself with some of the things you need to do, and you want a family member to start helping take care of you where the care is minimal upfront, then you can have that cash to supplement them not going to work. And as it progresses, you can turn from them going to in-home care to maybe hospice care. But because they've had cash and you receive what you need, you don't have to spend it all. You can save it all. You can reinvest all, whatever you want to do with that cash. And that gives you a lot of flexibility because it gives you choice of who you want to go to. All right. A lot of times Medicare and other programs like that force you to a certain type of provider. And if you're not comfortable or it's not functional for you, you have that flexibility to pick.
Gotcha. Okay. Well, I guess, the next logical question is, can you get long-term care plan when you're not healthy? Or do you have to be very, very proactive and do it very early in the stage?
So it's always better to be proactive, right? Today is the best day. Yesterday was even better. So when it comes to life insurance products, the younger, the healthier, the better, because the better rate, right? You're buying at a healthiest age. So the younger you are, right? Let's say I'm a stud, but I'm 25 versus me being a stud at 40. I might be even healthier, right? Because I've been fit, whatever, but because I am 40, I'm going to have a higher rate than a 25-year-old. Even maybe that 25-year-old is not that healthy, but because he is younger, you get better rates. So yes, starting sooner is better than later.
But if you're later, like, again, going back to like the second half of life, for example, then you can still get a long-term care plan.
Correct.
It's just that your premiums are going to be reflective of where you are in your lifespan.
Right. So once you pass a certain age, the price gets steeper. That's why also it's great to find out if you're still healthy, and you have a life insurance policy already whole life. If there's the possibility of adding that long-term care rider to it. Some companies, depending how long ago you got that policy, will add the long-term care rider without underwriting, medical underwriting. Okay. But if not, you would have to go to medical underwriting, and they might rate you differently for your long-term care than for your policy itself. But the good thing is that your policy stays at the rating you had. So if you were what we call preferred plus, meaning you were a stud, right, or studette, then that stays. So your life insurance premiums does not change. You're just going to add the premium for the long-term care rider. That might, be different depending on your health. If you don't qualify on the health side, like I said earlier, then that's where we can go the annuity route, right? There's certain types of annuities that give you guaranteed income and can double up whatever you have there as a long-term care rider. Now, there is an elimination period like everything else, and there are some rules and stuff and maximums and minimums they have to follow. But like I said, it's better than not having any protection at all, because it can really destroy a family financially if they don't have a plan in place. Right, your average Medicare, your average Medicaid, your average savings are not going to cover all these extras that most people don't plan for, even though it's a high certainty.
Gotcha. So Arturo, if somebody is touching 50 years or is getting past to that stage, what advice do you have for them?
So the biggest advice I would give them is get rid of your debt. Right, attack debt. Debt will eat your savings like you have no idea. Most people underestimate the negative power high interest debt has on their future. So especially if you're past 50, you have to aggressively attack your debt, eliminate that debt. Secondly is get proper protection, right? Ensure you're protecting yourselves and not becoming liability for your family. One of those things, and it's a big trigger I find in people, is they're not thinking long-term, and having a basic will, which includes a HIPAA release, a medical power of attorney, a financial power of attorney. Those things, having them in place, sets up your family for success in case you're not gone. Because whether you have, some people don't do it because they say, I don't have assets. So, but still, the little you may have can become a big problem and a big liability for your family if it's done in writing. If you're incapacitated, you need hospice care, and you can't make decisions for you. Yes, your spouse or a direct relative can make some decisions for you, but it's still, you can still be technically overridden by a doctor if the doctor disagrees with you if there's just not something in paper. And let's say you have a health insurance and you have to make a call to figure out if whatever is procedure or thing is needed is covered, and you don't have a HIPAA release, they will not release information for you from the employer or from the insurance. So having those things in place is important. And let's say you have separate accounts, or let's say you're a widower and your spouse is not here anymore, and your kids need access to your account to pay the deductibles, to pay whatever. They can't access it legally if they don't have a power of attorney. So those are some big things, and that creates problems when they need the long-term care or the hospice care or both.
Gotcha. Well, Arturo, how do my viewers get in touch with you?
So great question. They can go to wealthwave.com/Arturo Barillas. They can call me at 760-282-5179, or they can find me on Instagram at R2D2_Barillas. I am there. And pretty much anywhere out there, just put my name and this beautiful hairdo will pop up. And I'm there to help them. And what I love is everything we do is no strings attached. So we give the financial education to people. We share a book our company published called How Money Works, Stop Being a Sucker. And it's an amazing, fun read. We can give it to you, no strings attached. And here it is. Here's a copy of the book, right? And they can find it online, request it from my website. I'll get it to them free of cost, and they can use it as they see fit.
Excellent. Well, Arturo, this was an amazing show. I learned a lot. I know long-term care is not generally on people's radar when they are in the the second half or the second phase. But I think having that and being able to plan for it proactively will certainly benefit them in having more options when they actually need the amount of care that they do. So
you nailed it on the head there. Having options is the key, because if you're against a rock and a hard place without an option, that's not a fun place to be in. And having those options is awesome. Like I normally love to say, I can't do anything about the emotional distress, but man, can I help you for that financial distress, right? Exactly. Or actually preventing it.
Exactly. Thank you so much, Arturo, for being on the show. It was an amazing series. Thank you.
Yes, thank you so much for having me over. Look forward to seeing you again.